Hello and welcome to One-to-One Mining Investment APAC Online. Today we have Wilma Swarts, Director of PGMs for Metals Focus, giving us the outlook on PGMs.
Good day, my name is Wilma Swarts. I'm the Director of PGM Research at Metals Focus. By now, most probably everybody is so accustomed to online versus face-to-face conferences, and I really do hope that your sessions are going well and that they are insightful. I'd also like to thank One-to-One Group for the opportunity to talk to you a little bit about the platinum and palladium market and what Metals Focus outlook is for this year and then, of course, 2021. We're also going to pause and spend a little bit of time to look at what the impact of electrification will be on these two particular years. So before we dive into the detailed supply and demand factors for 2020 and 2021, which, spoiler alert, will be heavily weighted towards the pandemic, it's worthwhile to remind ourselves of the geographic dislocation that exists between supply and demand and the nuance and variance of this geographical dispersion between platinum and palladium. As you will notice, platinum supply, mine supply, is heavily weighted to South Africa, with both Merensky and UG2 containing higher platinum ratios. Zimbabwe, though a small contributor at the moment, is host to some of the richest deposits in the world. Looking at Canada's Sudbury Basin and the US's JM reefs in Montana, there is a greater bias towards palladium. Further northeast, the vast nickel deposits in Russia is currently the world's single largest source of palladium, with Russia contributing around 40% of global palladium mine supply. In contrast, demand is more evenly distributed for both metals, which is also the reason why, when we look at the secondary supply market, this is more widely distributed. But more on those topics later. Turning to mine supply first, we expect global platinum mine supply to fall by 15% to 5.2 million ounces. The lion's share of these losses can be attributed to South Africa, with most other regions reporting downgrades of a far lower magnitude. I want to pause on 4 dates in relation to the 886,000 ounces decline that we see in South African supply this year: 6 March, 26 March, 1st of June, and the 20th of September. So on the 6th of March, Anglo American Platinum declared force majeure on its contracts due to a shutdown of the entire converter plant. ACP Phase 1 was shut down in February following a coal dust explosion, while the alternative Phase B unit was taken offline due to high risk of explosion after water was detected in the furnace. And this resulted in 80 days of stoppage. On the 26th of March, President Ramaphosa declared a state of disaster, and South Africa went into complete lockdown. Then on the 1st of June, South Africa transitioned to level 3 lockdown, allowing mines to resume full operation, leading to operational levels of around 40 to 80% in Q2 and Q3 of this year. On the 20th of September, South Africa transitioned to its lowest level, and most operations have returned to full capacity, except for a handful of conventional Western Limb operations. Palladium production was less affected, but it's still forecast to be down 10% to 6.4 million ounces. The decline will be driven by lost production in South Africa, alongside lower output from Russia. Increased production from the US will marginally offset these falls as the FDM project at Sibanye-Stillwater operations advances. For 2021, we forecast that production should return to normal levels. Our 2021 outlook of 6 million ounces for platinum and 7 million ounces for palladium is respectively 16% and 11% up, and only marginally below what we had anticipated it to be at the beginning of this year. Platinum recycling is expected to be down 12% for the full year. and to recover by 8% in 2021. All areas of recycling have been negatively affected by the COVID-19 crisis, with losses being particularly acute in auto catalyst recycling, specifically in Q2. Jewellery scrap in Q2 rose as China came back to life, but global volumes were still sharply down 19% year on year due to less inventory recycling in China and lockdowns elsewhere. In 2021, we expect jewellery platinum recycling to recover by 17% and be back up above 450,000 ounces. This year, we estimate that platinum auto catalyst supply will be down 10%. This is due to a combination of various lockdowns and the decline in new vehicle sales, which impacts the supply of end-of-life vehicles. That said, the 2020 total will still be the second highest in our series. And we forecast that auto catalyst recycling will grow by 6% in 2021, back up above 1.5 million ounces. COVID-19 has also affected palladium recycling, though less pronounced in comparison to platinum. It dropped 8%, or it's anticipated to drop 8%. Auto catalyst recycling has contributed the bulk of the losses so far, just simply because of its dominant share in the palladium scrap market. By contrast, jewellery recycling for palladium has been broadly stable, but at very low levels, while electronic scrap decline is largely due to the falling palladium content in recycled electronic products, which is a combination of restrictions in movement as a result of the pandemic and the incredibly high palladium price experienced. If we turn to demand, the largest component of demand for platinum and palladium remains the automotive sector. And there are three elements that we look at when looking at automotive demand that influences the growth or the decline in platinum and palladium demand in automotive sector. First, vehicle unit production. Second, the metal loadings and the associated emissions of the country. And the third is the powertrain type. Looking first at the vehicle units, the pandemic has had a dramatic effect on vehicle sales and production. First in China, where we saw production drop by 46%, while the impact was less pronounced in the other regions. But then they, in Q2, dropped dramatically, with Europe and North America posting 46 and 60% decreases in Q2 as the virus impact became more severe. Conversely, in China, we saw a bounce back and an even growth on year-on-year growth of 7% in Q2. Because of the unpredictability of this black swan event, the automotive production forecasts for the year have been quite fluid. In total, the light-duty vehicle forecast has been downgraded by 15 million units compared to the forecast at the beginning of the year, at the beginning of 2020. Despite the recovery surprising to the upside, LMC Automotive cautions that the damage to the vehicle industry will be lasting and have ongoing risks. So similar to light-duty vehicles, heavy-duty vehicles was also significantly impacted, with downgrades of 25% and 34% experienced during the first 2 quarters. For the full year, heavy-duty vehicle production is expected to be down 25%. And in 2021, we expect light-duty vehicle to recover by 13%, and heavy-duty vehicles by 14%. But to be clear, the light-duty vehicle recovery at 84 million units is still quite a way behind the 2019 figure of 89 million and way below the record high of 95 million in 2017. Now, this very busy table is just a summary of the emissions legislation for the various regions. And the second component that impacts platinum and palladium demand is emissions legislation. And emissions legislation standards continue to tighten in a bid to decarbonize the world and reduce emissions of other pollutants such as NOx and hydrocarbons in the combustion of fossil fuels. As you can see, the emission legislation continues to tighten in all markets, but of particular interest for 2020 and 2021 is the European and the Chinese emissions legislation. In Europe, Euro 6D, new testing regimes, real driving emissions, and a reduction of conformity factor allowances in respect of NOx and particulate matter. In China, China 6A standards, set to be one of the most stringent in the world, was set to be phased in from July 2020 and required a 56% reduction in CO2. And despite the official delays of the NOx and particulate number limits to 1 January 2021, most new vehicles have already adopted new standards, some even China 6B. Under the China 6B, there are further revisions to the emissions limits. Similarly, in heavy-duty China 6, we will see permissible NOx and particulate matter emissions reduced by around 70% from current China 5 emissions legislation standards. The introduction of particulate matter, the adoption of portable emissions measurements, and the adoption of world harmonic stationary and transient test cycles. All of this will require heavier loadings and more metal. Lastly, on the automotive demand, from an automotive demand perspective, in 2020, pure diesel and gasoline vehicle share is forecast to drop to 89% in 2020, compared to 96% in 2017. A lot of this has to do with the incentives introduced that have been targeted at zero emission vehicles, premised on the continuation of government incentives favoring battery electric and zero emission energy vehicles. The OEMs anticipate that pure battery share will increase to 4% and hybrid vehicles will increase to 12%. However, despite the shift away from pure internal combustion engines, platinum and palladium demand for 2020 and 2021 timeframe will show marginal impact. In fact, due to the engine configuration and the thermal differences between pure ICE and hybrid vehicles, the latter have higher metal loadings as a requirement. So what does that mean for platinum and palladium demand? Given the severe impact of the pandemic to Europe, on the basis of the incentives and the bias towards battery electric vehicles, we see platinum demand decline by 16% in 2020. However, we expect a strong recovery in 2021, growing by 25% and breaking through the 3 million ounce mark. Driven by the growth in demand predominantly from China, both light-duty vehicle and heavy-duty vehicles, which favors platinum, we have factored in a small amount of substitution as well, substitution away from palladium into platinum as we see the high palladium price persist. Palladium demand is expected to be down 12% in 2020 and will recover in 2021. To put it into context, despite the fact that vehicle production will still be below 2019 demand levels, we expect that the palladium recovery will be stronger as a result of the emissions legislation, as we discussed earlier. Turning to jewellery demand, global demand for jewellery dropped 27% in the first half of 2020 and is forecast to decline by 14% for the full year, but it will recover by 13% in 2021. This upward revision is premised on the assumption that platinum will maintain its hefty price discount to gold, which will continue to encourage interest in platinum among jewelers. This will lead to a decent stock building by the jewellery trade, though these gains are likely to be broadly offset by the negative impact of lower consumer spending and a shift to lighter jewellery pieces. In China, we expect a 13% recovery due to jewelers increasing promotional activities and inventory building, as platinum's widening discount to gold and the low price regimes will make platinum jewellery particularly attractive. Fabrication in Europe and North America dropped dramatically due to closures of retailers and postponements of weddings. However, in the second half, we've seen a recovery as markets reopened, and it also included a little bit of pent-up consumer spending. We remain cautious as sentiment could deteriorate, seeing that unemployment may rise and government support schemes may be unwound. Palladium global jewellery demand is expected to slump 33% in 2020 due to COVID and record high palladium prices. There should be a rise in 2021, but the structural problems are in evidence, with demand expected to be 24% lower than in 2019. Overall industrial platinum demand is forecast to post a small decline of 2% this year, largely as a result of COVID-19. We expect that a full recovery in 2021, actually surpassing 2019 levels. These are predominantly as a result of expansions in glass and chemical sector, mostly in China, which will drive the growth. In electronics, despite increased hard disk drive shipments, the shift from hard disk drives using platinum to solid state drives with no precious metal content will weigh on this sector. Further ahead, a global economic downturn as well as a continued trade tensions might well weigh on the recovery of the electronics sector post-COVID. Petroleum is expected to record significant fall. It dropped by 42% in the beginning of the year, as oil refining industry was hard hit by COVID-19. In 2021, we expect it to recover, but we don't expect it to return to 2019 levels. Other industrial demand for spark plugs, sensors recovered, but will decline as a result of the decline in automotive demand. Looking ahead, tightening emission standards and a shift from diesel to gasoline in Europe will continue to drive offtake in this sector. But hydrogen fuel cell deployment and green hydrogen production may contribute to demand, albeit small in 2020 and 2021. Palladium global industrial demand will drop 12% and is not expected to recover in 2021. The high palladium price will weigh on electronics and the dental segment, while thrifting and substitution has had a limited impact on the chemical sector. Petrochemical sector constructions of new plants, specifically in China, are expected to proceed. Turning to investment, the positive spillover from gold has been the principal driver of fresh investment into platinum in recent months. Widening platinum gold differentials during 2020 to date has encouraged investment from those investors who perceive platinum as undervalued. Investment sentiment has been further boosted by the EU's hydrogen infrastructure plan and the prospects of potential substitution of palladium in favor of platinum in auto catalyst. For next year, given the fact that we are still expecting significant uncertainty at macro level, the investment case for precious metals will remain strong. Turning to specific metal flows and holdings, by the 24th of September, platinum ETP holdings stood at a record high of 3.7 million and is 420,000 ounces up from the start of the year. During the first 9 months, European and US funds increased holdings significantly, while South African funds reduced by 21%, driven mostly by a need for cash, specifically during the March fallout. In contrast, by mid-September, managed money on the Nymex futures have seen gross long positions and shorts, long positions halve and short positions double. Palladium ETPs have been at an all-time low and shed a further 7% since the beginning of this year. This is not unexpected, as the tightness in the physical market has seen palladium prices reach record highs and led to some profit taking, and also some sentiments that perhaps at the current high levels, perhaps investors are more cautious to invest in palladium. Managed money positions on Nymex has, as with platinum, reduced dramatically, with longs reducing 62% and short positions dropping by 7%. I think the other flow of metal that's interesting to cover or to look at is the exceptional volumes of platinum and palladium that have been shipped to New York and delivered into Nymex, to the Nymex approved vaults and warehouses. In our view, this has been due to the widening of EFPs, or exchange for physical. So to give some color on this, the difference between the EFP is the difference between the spot price and the futures price. And this difference has created an arbitrage opportunity or a high cost situation, which has encouraged contract holders to deliver against short futures positions that they hold. In our view, it is likely that the EFP will remain wide, and this will encourage this metal to continue to remain in New York. And we wouldn't rule out the possibility that there could be some further inflows in the future. So platinum, as at last week Friday, platinum stood at 521,000 ounces and palladium at 119,000 ounces. So following on from this review of supply and demand movements, we see that platinum will remain in surplus this year, albeit much lower than the surplus of 2019. And in 2021, as mine supply from South Africa is expected to recover fully, while demand from key markets such as Europe will still continue to struggle to shed the impact of the pandemic, we expect the surplus to widen somewhat. As a result, we also see above ground stocks increase. Conversely, palladium, on the back of fundamentals, we expect palladium to be in the 9th and 10th consecutive year of deficits. However, in comparison to 2019, the deficits will be significantly lower than what was posted between that 2016 to 2019 period. And as a consequence, we expect above ground stocks to be drawn down further, down to 12 million ounces. So what does that mean for prices? So finally, taking a look at the prices, starting with platinum, we indicated that the fundamentals at this moment is not that attractive, but it is both an industrial and an investment metal. And due to the current macro environment and the preferences for safe haven asset classes, it will remain attractive throughout the rest of the year and into next year. With exceptional liquidity resulting from aggressive monetary and fiscal stimulus, we expect platinum to continue to follow the trends in the precious metals complex, with 2020 prices of around $880 and a possibility to test highs of 1,100. In 2021, we forecast a price closer to $1,000 on average. Turning to palladium, we are quite bullish about the palladium, but unlike platinum, this is based on the fundamentals as opposed to the monetary and fiscal stimulus. We see the recovery of the fundamental market will lead to increased market tightness, and believe that palladium could potentially test record highs again. We forecast the average palladium price to be $2,200 during 2020 and could reach $2,600 in 2021. And with that concludes my presentation. And I'd like to thank you for your time and take this opportunity to remind you of who the team is that puts together not only our 1 year, but also a 5-year outlook. And that the team also, aside from looking at platinum and palladium, also covers gold and silver. Again, thank you to One to One Group, and we hope that you enjoy the rest of your conference. Thank you.